Good morning, everyone, and welcome to our interest rate market update on the 1st of August. My name is James Sheehan, and I look after the interest rates, FX, and commodities risk advisory business here at NAB in New South Wales. So yesterday, the CPI data came out at 0.8% quarter on quarter, against a forecast of 1%, and a collective sigh of relief was heard from mortgage holders around the country. However, the market for fixed rates has had some interesting moves that we'll discuss later on. Before the data was released, the market was pricing a 25% chance that the RBA would put the official cash rate up next Tuesday. This has now changed to a call of hold from the market for next Tuesday. However, with inflation still materially above target, the pathway to rate cuts is extremely uncertain. With the recent movement in sentiment around the RBA, we thought that this webinar would be a good idea to run a poll. So following Tabitha's presentation, before we go into Q&A, we'll launch a poll asking people what they think the RBA will do next week and see if this group's vibe is similar to that of the market. Today, we will hear from NAB's Chief Market Economist, Tabitha Strickland. Having a long career in economics, including 6 years at the RBA, Tabitha now plays a key role in forming NAB's large customer base on Australian and global economic trends. One place you can hear Tabitha regularly is NAB's Morning Call podcast, and later on within this presentation, you'll receive details on how you can subscribe to that podcast if you don't already. Good morning, Tabitha.
Good morning, James.
We're also joined by Dan Farrell, who is a director in our New South Wales Business Markets team. Dan has over 10 years' experience in risk management advice with NAB and runs a team of interest rate market specialists who are based in metropolitan Sydney and regional New South Wales. They speak with customers about what is happening in the economy and work with them to manage their interest rate risk. Good morning, Dan.
Thanks, James.
So Tabitha will give us an update on market conditions and help us to interpret the RBA stance on data points and what we might expect next Tuesday. As always, we encourage people to put questions in the chat during the webinar. There's a Q&A function down in the webinar, and we'll endeavour to get to those questions live as we go throughout the webinar. The update is designed to be short and sharp and get in and out in 30, 35 minutes. So if we don't get to your question, we will circle to you individually. Over to you, Tabitha.
Thank you, James, and good morning, everyone. As James has said, we did have Q2 CPI data yesterday, and that did see a material change in market pricing for the RBA. The headline true mean number came out at 0.8% Q on Q and 3.9% year on year, and it came in a little bit below where the market consensus was, which was for 1% Q on Q and 4.0% year on year. But interestingly, relative to where the RBA thought inflation would print back in May, inflation actually printed slightly higher than what they were expecting. They were expecting a true mean print of 3.8% year on year. So although it did come in lower than where market expectations were and pared back any thought that the RBA would need to hike rates in the near term, it still is saying that inflation is running slightly hotter than what the RBA would like it to be. And in our view, it's going to take a little bit longer to get inflation back towards that target band. So while market pricing has moved towards a flat for the meeting next week and pricing in a chance of an RBA rate cut by February, at NAB, we think the next move is likely down but won't occur until the middle of next year, and we've penciled in May 2025 for that to occur. You can see relative to where market pricing was going into the meeting relative to where market pricing is now, there's been a considerable move in the structure of rates, particularly for the next 1.5 years. But what I find interesting is even with that movement, markets are pricing in a terminal RBA cash rate of around 3.5%. So our view has been for quite some time that the timing of the RBA cycle was a little bit uncertain, just given the trajectory for inflation was uncertain. But we're not going back towards that pre-pandemic world when rates fell down to, say, 1%. It looks like we are heading into a world where we're getting back to neutral, and neutral is anywhere between that 3 to 3.5% mark. So that's our view in terms of rates in the longer term. But relative to where our view is in the near term, as I said before, market pricing is for a rate cut in February of next year, but we think the next move is probably more likely to occur in May, and it's going to be a relatively gradual rate cutting cycle in this cycle. With inflation still above the RBA's target band, they're going to be looking quite closely at the activity side of the economy as well, particularly the unemployment rate as well. And the unemployment rate at 4.1% still remains vastly lower than where it was prior to the pandemic, when it was at 4.2%.
Thanks, Tabitha. I was just going to say a couple of things to point out on this chart, because there's a bit going on there. I think firstly, it's just how volatile the market pricing has been. So you can only see a month ago the expectations for rates to roughly be about 50 points higher than where they're currently expected. It's only really been driven off one really key data set. So I guess as a key takeaway for customers is that this is very, very volatile. It can swing around based on the data available at the time. So not necessarily, it is only a forecast in that regard, and to take it with a grain of salt, because forecasts are not perfect, and we need to consider probably a wider range of factors when we're making our business plans out for the medium term, particularly around interest rate risk. The other key point probably just to make here is that this is cash rate tracking, as opposed to if you've got debt, your loan will be based off BBSY. So the BBSY levels would expected traditionally be about 20 points above cash. So if you're looking at a 3.5% cash rate there, then BBSY is expected to be around 3.7% or so, which is actually where your loan rolls over. So I guess in terms of a reference point for them moving forward.
I just wanted to ask you, Tapas, there, and there's a bit happening in the bottom right corner of that slide, but just to interpret a little bit about what that means around a neutral rate and the term shallow cutting cycle or how it might look. What's your view? And just tell us a little bit about that bottom right and what that means around neutral rate.
It's a very good question. When I present to clients, they can accept the kind of short-term view, but what they really want to know is where policy is going to be in 3 to 5 years' time. So when you're kind of managing your actual interest rate risk. And there you go back to some kind of concept of where you think rates will be on an average over a cycle. And one of those concepts is called the neutral rate, and that's effectively where inflation is low and unemployment is low. And you can run a whole heap of different types of models, and the RBA recently updated their own estimates of where they thought the neutral rate was. And in a recent speech, Assistant Governor Chris Kent said the neutral rate was probably around just a little bit above 3.5%. So that can kind of give you some ballpark where absent aggregate demand shock or aggregate supply shock, that's effectively where rates should coalesce over a longer cycle. And that's broadly also where market pricing is also coalescing in terms of where the RBA neutral rate would be.
It's a really good point just around that medium-term view or outlook. It's not necessarily, this chart really covers the next 18 months effectively or 2 years. But when you're sitting down and doing your business plans, you're typically looking at 3, 5, maybe even longer. And I guess that's the key in terms of making the decisions for the business over that medium term, as opposed to the short term. In the short term, it looks like there's potentially some relief on the way for debt holders, but it's interesting to see that red line start to actually track up. And so the question is, does that trajectory continue to go up? Does it stabilise? Does it reverse and go back down? And that's the conversations that we should be having with customers around managing medium-term risk and then potentially looking at insuring against that as well.
Definitely. And we've been of the view that the interest rate cycle is likely to be relatively shallow in this cycle. And the main reason for that is household and business balance sheets are still in a very, very good shape. And labour markets are mostly in a well shape compared to where they were prior to the pandemic. But in terms of the near-term trajectory for rates, both Australia and globally, it's really going to come down to what is inflation doing? Is it getting back to target in a relatively quick fashion? And is the unemployment rate remaining at relatively low levels? And just to give you some illustration for how Australia compares to the rest of the world and for why the RBA, in our view, is still likely to lag the rest of the world in terms of rate cuts, is if you look at 6-month annualised core inflation as a deviation from target, we're still running inflation above the RBA's target. So as I mentioned before, trimming inflation at 3.9%, the RBA targets inflation between 2 to 3% on average over the cycle. So still running above target. Interestingly, what I find also is in countries where inflation has come down to target, it's actually ticked back up again, especially in Europe as well. So that does lend itself towards a shallow rate cutting cycle because inflation, for whatever reason, is ticking back up in some of these economies. In Europe, it's because you're getting less progress on goods disinflation. And in prior webinars, we've been talking about geopolitical fragmentation risk and how that may actually see what we did see in the prior 2 decades, goods deflation, actually turn to slight inflation or maybe just no price growth whatsoever. So that would mean the services side of the economy in terms of inflation would have to come a little bit lower than what it did in the prior pandemic. The 2 countries that have cut rates relatively more than other countries are Sweden and in Canada. And in both of those countries, inflation is at target and the labour markets have deteriorated a lot further. But in Australia, as I said before, the unemployment rate is 4.1%, vastly lower than the 5.2% that we're at just prior to the pandemic.
I guess just quickly, we've got a couple of questions coming through, probably more in relation to the previous slide, Tapper. So the first one is the absolute $1 million question that we get asked a lot. Effectively, when is the best time to lock in interest rates to get the lowest possible rate? The question's around market timing. So if I'm looking to manage my interest rate risk, when is the best time to fix? Is it prior to the cuts happening? Is it once the RBA has cut rates and it's so effectively, where is it? I guess I can have a crack at answering that one before you. In terms of markets are forward-looking, so the market, that curve is the best price, the market's best idea of where rates are heading given all the available information. So typically, markets move ahead of where the current monetary policy settings are at. So if there's expectations of cuts coming, then that works into the pricing immediately. If there's expectations of hikes in the near future, then also it'll be factored into the pricing. So typically we do find that if customers are really trying to pick the bottom, which is incredibly hard to do because we don't know where the bottom is until we're past it, it is typically when there is a forecast of interest rate cuts to come because there's uncertainty in terms of how far we could go. And particularly if you're a believer in what potentially could be a very shallow cutting session, as potentially we are, then it could provide some good opportunities now while, particularly after the data, interest rates dropped 20%, 20 basis points yesterday off the back of some poor data. It has provided a lot of opportunities for customers to effectively buy the rate cuts now in their hedged rates.
And I think it goes back to the earlier point that they're making, is what type of cycle are we in? What are we responding to by cutting rates? And it doesn't seem like there's a big global demand shock. It doesn't seem like there's a big global supply shock that we're cutting rates aggressively in this cycle. To me, it seems like household business balance sheets are in relatively good shape, and maybe the 95, 96 US Fed experience is probably more apt, where the US Fed cut rates 3 times within a year. And the reason why they cut rates was because of recession risk. And when that recession risk actually went away, then they stopped the easing cycle. And interestingly, during that time, the equity market rallied 20%. And that 20% rally caused the US Fed to actually ask themselves, is policy actually restrictive enough once they had cut it by 75 basis points? So there is a probability out there somewhere that we're in that kind of 95, 96 cycle where we have a relatively shallow cutting cycle. We're definitely not in the period where we were prior to the GFC when there's a lot of uncertainty in terms of global banks. It just doesn't seem to be where in that cycle. And that's part of the reason why we've got a relatively shallow forecast in terms of rate cuts for the RBA in this cycle.
There's also a great live question there about inflation and how hard is it to get down. So not to preempt your next few slides, but we'll cover that on sticky inflation and what's driving it. So.
Yes, and this goes back to the point we were making earlier about geopolitical fragmentation risk. So these two charts here break up the inflation into goods and services. So goods is really easy concept to have. There's a lot of import competition. Australia imports a lot of consumer goods. In the prior 2 decades, Australia actually experienced goods deflation. So if you look at market goods, excluding housing, tobacco and food, you'll notice over the prior 2 decades, we actually experienced negative prices for goods. What we have seen over the past year is a bit of volatility in terms of goods pricing, but zero price growth in terms of goods. We haven't seen too many signs of outright deflation in goods, which we did experience in the prior pandemic period. If part of your basket is no longer seeing deflation, then that means the other part of your basket, which is services, has to see more moderate inflation. And so this is the reason why I'll talk a little bit more in terms of these geopolitical events later on, but the prospects of fragmentation of going forward under a possible future Trump presidency or even under a possible Harris presidency as well. Are we in for a more vulnerable supply chain, in which case maybe you don't get that long downward trend in goods inflation. On the services side, I think everyone on this call will sympathise. Services inflation is running way too hot in Australia. Core market services, excluding travel and telco, is running at 5.7% year on year. If you look at that chart, it basically ran about 3% prior. Core market services, excluding rents, is running at 5.22%. We are making progress on getting services inflation lower, but it's still running too hot. And that's part of the reason why we think The market is probably running ahead of itself and a few other commentators out there. If the RBA is cutting for inflation alone, I think it's going to take another couple of quarters for the RBA to get more comfortable in terms of the outlook for market services inflation, just given how high services inflation is in this cycle. When you look at some of the big components in terms of what drives inflation, two really big components are rents in terms of what do households pay in terms of the rental market, and new dwelling construction costs. And when you look at those two components, you can see rents are contributing a lot in terms of inflation, and new dwelling construction costs are also contributing. At the moment, we are approving about 163,000 dwellings a year in Australia. The government wants to build 240,000 dwellings. When you look at the commentary amongst most of the participants, they're all suggestive of cost inflation at 163,000 dwellings. Most of that cost inflation is coming from the labour side, where the material side has come back in. And most importantly, the reason why you're seeing labour cost pressures there spilling over into new residential construction is because of competition for labour from government infrastructure work. And there's a lot of demand for government infrastructure work out there, also with the green transition as well. So this secular trend of housing-related inflation in the consumer basket, I think, has further to run. And one reason why inflation in Australia could prove more sticky than it is offshore, both because of rents and also new dwelling construction costs. On the positive side, the kind of components of the inflation basket that most represent labour services, that degree of inflation has come back in. So it looks like a lot of the inflation is on the kind of the housing side, new dwelling rents, and also on the insurance side as well. In terms of geopolitical risk, the two key things we're looking out for is the US presidential election come November. And there's a lot of uncertainty here. There's a lot of water to go under the bridge. Up until yesterday, betting markets were ascribing a better probability of Trump becoming president at the end of the year. I just checked betting markets then, and because of a disastrous interview performance last night, betting odds now have Harris as slightly better odds in getting the presidency towards the end of the year. So you have seen a dramatic change and a dramatic turn, and James was talking about the volatility in interest rate markets. Volatility in betting markets for politics is just as crazy. But the key things that I always point to is, regardless of whether it's Trump or Harris, both are probably likely to remain relatively aggressive in terms of their relationship with China. So that's going to put more sand in the gears in terms of the possibility of geopolitical fragmentation, or at least diversification of supply chains. And the three key headlines that Trump has kind of campaigned on, and he'll probably bring back the rhetoric if he were to become president, is he wants to put a 10% across the board tariff on, a 60% tariff on China. He wants to build a wall and deport undocumented migrants. So both of those two policies would be inflationary, at least in the near term, for the US economy. And the third one, he'll likely push back against the green transition as well. And just related, he would like other countries to pay their fair share of defence spending. So that possibly leads to greater geopolitical fragmentation risk. And the reason why I bring that up is at this point in time, it doesn't look like we're heading back into that pre-pandemic environment of low inflation and one country dominating the rest of the world. It looks like we're going to a multipolar world, where it seems like countries are coalescing into different types of blocks, whether it's a US a NATO kind of aligned bloc, China aligned bloc, or a more of a neutral bloc. But that does tend to put sand in the gears in terms of inflation. The other one in the short term is really what's going on with Israel and Hamas. It looks like that conflict has the potential to spread a little bit further in regards to the recent bombing of a building in Lebanon, targeting Hezbollah, and also an assassination of a Hamas official in Iran as well. So that's seen the oil price spike up over the past 24 hours by 3 or 4%. Looking quite closely at that, what we can say at the moment is over the past year, there has been a spike in container freight rates as passage through the Suez Canal is quite difficult, very hard to get insurance. So they're having to go around the Cape of Good Hope. That reduces containers, puts vessels at sea for longer. That's seeing freight rates lift. And so for many clients, you would have seen the cost of containerized freight lift quite a lot. Now, that's only going to impact on certain bits of the consumer basket, such as imported furniture, imported electronic products, those kind of things. But it does also suggest that if we had this 2-decade experience of declining prices for these products, maybe this is one of the things that stops that secular decline in the price of those products. In terms of where the economy is right now, I think we're at a really interesting juncture. When you look at business conditions, they've been well above average for the past 2.5 years. Our most recent survey suggests business conditions have come in to average or slightly below average now. So it looks like all that pent-up spending is probably worked its way through many business sectors, and maybe the effect of tightening monetary policy is also starting to be felt by consumers, and that's starting to be reflected in business conditions. Throughout this cycle, business confidence hasn't been very high, but interestingly, business conditions have been always higher, and consumer confidence has been relatively weak. But interestingly, when you ask consumers why are you not that confident, it's not because of the level of rates, it's actually because of the degree of inflation. Stepping back to the business side, when you look at the various business sectors, the two sectors that seem to be the weakest at the moment really is retail trade and wholesale trade. And so that is probably most reflective of the impact on consumers, but also a pivot in consumption as well, away from goods, more towards the services side. On the services side, conditions in recreational personal services and finance property business services are still at average or above average levels. And in transport utilities, it's still relatively okay as well. Construction is very mixed. I was talking about the uncertainties in residential construction. If you are exposed to infrastructure construction, conditions are still very, very strong. So very divergent business conditions right across Australia. And then when you look in terms of the forward-looking kind of components, like if you look at the equity market by sector, there's been a broad-based rally across most sectors apart from the material sector, where the uncertainties in China are weighing the most. In terms of some indicators of household stress, we haven't really seen it. So if you look at arrears rates on credit cards, haven't really picked up when you look at balances accruing interest. In the old days, we used to look at cash advances because you'd probably take out cash if you were wanting to manage your cash flow a little bit better. We haven't really seen too much of a pickup there. That also points towards a relatively shallow cutting cycle as well. If households have been able to navigate this higher rate environment and also the significant rise in prices, as inflation starts to come back down and gradually get back to target, you'll start to see real income gains, and then maybe doesn't take too much in regards to cash rate cuts to really get the economy growing again.
I think that's a really key slide as well, because one of the conversations that comes up with customers is how are people absorbing the higher interest rate environment. And I think in previous webinars, you've showed the accumulated cash balances that households have received, I guess, over the last couple of years since the pandemic, and it's over 200 billion or so, and we're starting to see that deplete to come back down a little bit, but it's still at much more elevated levels than prior to the pandemic. It just shows, I guess, the resilience in the household sector in face of everything that's been happening.
Oh, definitely. And I think you almost have to take 2 steps back and just think what makes up the household sector. So a third of households rent, a third of households own with a mortgage, and a third of households own without a mortgage. So there are some segments of the population where they are performing relatively well. If you look at household wealth, net wealth, so this is assets less liabilities, since the pandemic began, household net wealth across the household sector is increased by 50%. Now, a large degree of that is due to the value of dwelling assets, but also due to equities, also due to the stock of deposits, as Dan was talking about earlier. And then if you look at the very top sector, if you look at the number of households that have net wealth greater than $1 billion US, in US dollar equivalent, that has increased by 1 million people since the pandemic began. So for some segments of the population, they have seen a dramatic increase in household net wealth. And maybe that goes towards some of those resilience pictures that we're talking about. And then prior to the pandemic, for the households who did have a mortgage, as rates fell during that pre-pandemic environment, many of them kept the same level of repayment. So they built incredible mortgage buffers. And what we have seen through the data is households continuing to add to those mortgage buffers. So there's been no drawdown. And the third thing that has added to that resilience is just how tight the labour market is. So the unemployment rate of 4.1%, dramatically lower than pre-pandemic, where it was at 5.2%. For cash flow constrained households, hasn't necessarily been easy, but they've been able to find more hours of work and potentially changing jobs as well, potentially partners also entering the labour force as well. And that's adding to a lot of the resilience in the economy today. Going back to one of the big challenges in the economy is really around the housing sector. Population growth over the past year has run at 640,000, and we've only approved 163,000 dwellings. There's very many estimates of dwelling undersupply, and some of them say dwelling undersupply ranges anywhere between 150 to 250,000 dwellings. It's going to take some time for stresses in the household sector related to housing markets to really abate. And so that's the reason why, among some components of the CPI basket, particularly residential rents and new dwelling construction costs, they could remain relatively sticky for longer and cause Australian inflation to remain more sticky than, say, in some other parts of the world. In terms of our FX outlook, it's a really interesting juncture. We did see the Australian dollar break out of that limited range that we had seen previously. Some of that was due to some views of the RBA perhaps lifting rates, and that's obviously come back down as inflation was not as bad as feared. And some of it is just due to the uncertainties that are going on in the global economy at the moment. The US Federal Reserve met last night. Chair Jay Powell gave a pretty clear shout out to September as when the first US Fed rate cut would be, and that has seen the US dollar weaken. And our view is US dollar weakness will see the Australian dollar lift. And so the Australian dollar at the moment is sitting around 65.45. We do see the Australian dollar lifting towards about 69 US cents by the end of 2024 and 75 US cents by the end of 2025. But again, going back to that geopolitical risk environment, we'll be looking quite closely about exactly what happens in the November presidential election. And if Trump if he were to be elected, does he go through his campaign rhetoric? And does he fulfill that? Would he be prepared to put a 10% tariff across the board? Would he be prepared to deport undocumented migrants out of the US? These are all very potentially inflationary policies and could keep US dollar strength going for longer than what we have forecast. So that's what we're looking at quite closely in terms of our Australian dollar view going forward.
I also just wanted to stop there because obviously, as we rely upon the Fed rate cuts to weaken the US dollar in that forecast, if the Fed was to push out a little bit or the positivity around a rate cut in Australia comes a little bit further forward, does that really weaken the Aussie's ability to rally? Because we really have seen it struggle to gather legs.
Yeah, and I think one of the reasons why it's really struggled to gather legs is because of the uncertainty in China. And China has changed the way that it is looking at its economy. In prior cycles, the Chinese authorities would aggressively stimulate, particularly on the investment side, and that used to really buoy commodity markets, and that flowed through to the Australian dollar. In this cycle, they're very conscious of trying to resolve some of the issues in the property sector, but doing it in a very slow way. So it's going to be a very slow burn resolve of the property sector. And they are looking to pivot their economy away from that investment-led to the kind of green transition and tech. And that isn't as favourable as the commodity prices that has been in prior cycles. So we just haven't seen that big aggressive Chinese fiscal stimulus come out. And they have been very reluctant to stimulate their household sector for whatever reason. And so the uncertainties around China could continue, and under a Trump presidency, maybe those uncertainties become greater because of the threat of tariffs. And so that's one of the reasons why the Australian dollar has been unable to rally consistently.
Yeah, push out of that range with any conviction.
Yeah. I appreciate I've covered a lot of ground, but the kind of three key takeaways really is, yes, Q2 CPI trim mean came in a little bit lower than where the market was thinking, but importantly, on a year-on-year basis, it was still higher than what the RBA forecast back in May. So that still suggests rate cuts are still a way off. And at NAB, we have penciled in the first rate cut in the middle of 2025. The market is pricing rate cuts a little bit earlier than that. In terms of where we see the RBA cash rate settling at, we see it settling at around 3.1%. The latest RBA modelling in terms of pegged neutral at around 3.5%, and that's pretty much where the market is pricing the kind of terminal rate in terms of the RBA cash rate so far. And thirdly, in terms of our optimism for a soft landing, both in Australia and offshore, it really comes back to household balance sheets. They are in incredibly good shape. We're not like we were in prior cycles when we were very late cycle in terms of balance sheets, and balance sheets were stretched. Balance sheet valuations are very, very good. Households have been able to service high mortgage costs so far, have been able to also accommodate the lift in prices as well. So we're fairly optimistic that we are in for a soft landing both in Australia and in the US as well.
All right, we've been going for just on 30 minutes. We're going to try and squeeze some questions in. This presentation will be sent out along with a link to the video. So if you want to go back over any of the slides, we can. Just while we go into Q&A, I'm going to pop that up on the screen, which is a plug for our research, the information that Tapas and his team produce. Most importantly, they're the Morning Call podcast, and that goes for approximately how long, Tapas? So as you get this right, 10 minutes?
Yeah, about 10 to 15 minutes.
About 10 to 15 minutes every morning. A great opportunity to hear what happened in markets overnight. So you can subscribe to that if you don't already. It's a fantastic way to gather information. Dan, I usually like to throw to you first, and we have had a good question there about products, but I'm going to just go back a step if we can. As we mentioned in the opening remarks, your team is out there talking to customers about interest rate risk management and their concerns all the time. What's been the response recently, and what have your team seen since the data yesterday?
Thanks, James. As James said, my team is out there speaking to NAB's customer base every single day. And the benefit of having a business bank franchise and a corporate franchise that we do is we bank roughly sort of 1 in 3 customers in Australia that do business. So we get to speak to a lot of people, hear a lot of different views, and also ask a lot of questions. In terms of that, we speak to them about how they're finding conditions, what inflationary pressure are they seeing, and also how that's impacting their business specifically. And so from those conversations, we were actually a little bit surprised by the data, to be honest, yesterday. The conversations we're having with customers, they're still finding inflationary pressures building in their business. They've still got supply chain issues. They've still got things, labour issues. They've still got wage issues sort of moving forward. And so they have been, the evidence there is that inflation is very much still there. So to see it sort of ease off a little bit in the trim mean was probably a little bit of a surprise to the team. But nonetheless, since the data has been released in the last 24 hours, we've had much more heightened activity coming through to look at to manage their interest rate risk. Really, that's based on customers still feeling that inflationary pressure is there, and they really are looking at managing their interest rate risk based on an insurance need. And with the softer data, as I said, swap rates dropped across the board roughly 20 basis points yesterday. So the cost to insure the business just became a lot cheaper. And so we've seen people taking advantage of that quite significantly in the last 24 hours.
We're just going to try and squeeze in 3 more questions. One for you, Dan, a really good one that came off the chat there. What type of hedging should I be considering? Fixed rates, cap, collar, or something more complex to get a lower rate?
Yeah, 100%. Without trying to sound like a politician, it really depends. And it's really important to clarify that. So it depends at what part or what stage your business is going through. So, for example, if you're looking to exit assets and pay down debt over the next, in the short term, managing interest rate risk probably isn't a priority for you, and nor should it be. But say if you're at the other end of the spectrum, you're looking to grow over the next 5 years, you're looking to go on, particularly a debt. Usually customers use debt to acquire new assets to go on those expansionary plans. You definitely should be thinking about how to manage your interest rate costs, because if you cannot, the biggest risk to you going and acquiring those assets typically is the interest rate exposure, and any adverse moves can stop you from buying that asset that you wanted to buy. And then you miss out on the income that would have generated, or particularly the capital growth, which is, in the property sector, for example, if customers were not able to continue to acquire assets in property, then they wouldn't have seen the large capital gains that they've seen over the last, 5 years, 10 years, 30 years for that matter. So it really depends on where the stage of your business is at. In saying that, there are some universal truths in this, and something that we speak to all customers about, and that is back to thinking of that hedging piece as an insurance business. And I use that, use an example of house insurance. No one really likes to pay for house insurance, and you don't buy house insurance with the view that your house is going to burn down. But if your house did burn down, you're pretty happy you've got the insurance in place. Similarly with interest rates, you manage your interest rate risk by looking at an option around 20, 30, 40 or 50% of your core debt, because you're buying it just in case something happens at the periphery. And typically it can be sometimes these where you've taken generations or many, many years to acquire these assets, but a couple of adverse interest rate moves means that suddenly you've got to start selling those down to pay off debt, and that becomes very, very tricky for a business to manage. So we talk about it in insurance, and what we've seen really over the last sort of 24 hours and even over the last couple of months is still a lot of customers looking at managing the 3 to 7 years in their interest rate exposure based on they don't really want to worry about interest rates. They just want to go back to focusing on running their business, and this is one of the things they can manage. And the other key, structure that people are looking at, given the amount of acquisition activity that's going on at the moment, we have had some customers enter into option-style products to produce a lower than variable rate for them over the next 18 months or 2 years or so. And the reason for that is they're making an acquisition. Initially, as you bring that acquisition online, it's not typically efficient. You're not generating the full cash flows and efficiencies out of that asset, but you've got to pay the debt up front. And so your interest cost goes up, but you're not necessarily seeing the increase in income. That is going to be coming to you in a couple of years' time. And so they look at entering into structures where they get a bit of relief for the next couple of years, as I said, maybe a sub-variable interest rate, with the interest rate moving up over time, but it also aligns when their cash flow profile improves as well. So that's the sort of things that have been particularly popular with customers recently.
Okay. I'm going to try and squeeze some questions into Tapas that we've got. I realise we're a little bit tight on time, so I'm just going to try and squeeze in a couple, and then we'll finish in a few minutes. Great question from Sean. Prior to yesterday's CPI, June quarter inflation was 1.1%. That was being seen as a catalyst for the RBA to hike. Where do you feel the next quarterly inflation or the quarterly inflation data needs to fall to in order to see the RBA move to an easing bias?
Yeah, it's a very good question. And I think it depends both on the inflation and the unemployment rate. So we got 0.8 on inflation. I think if it came in at 0.7, then that would start to bring open the possibility of interest rate cuts. So that's what we would be looking at. But importantly, it would have to be a 0.7% that isn't being driven by a lot of government subsidies. So there's a lot of government subsidies coming up, rent assistance, and also energy bill relief. That's going to drop headline inflation down. It has the potential to weigh on the underlying core trim mean measure as well. So I think you'll have to look at the details as well. But 0.7 in a quarterly sense would be enough. And this goes back to Dan's earlier point about the customer base. When you talk to customers, they're all saying there's a lot of inflationary pressure out there. It could be that inflationary pressure has been still disguised to some extent by government subsidies. So there is energy bill relief out there. There's some stuff on the pharmaceutical benefit scheme that's also impacting the CPI numbers as well. And there's some subsidies coming up in WA and Queensland as well. So getting a good feel on what the true rate of inflation is quite difficult. And I think that's the reason why we've seen a bit of volatility in the inflation prints today. But if you were to get a 0.7, I think markets would be racing away to say, well, next move is going to be down relatively quickly. But also the unemployment rate is going to be really important. So the RBA has been trying to maintain all the gains that we have seen during the pandemic period. With the unemployment rate of 4.1%, we're expecting it only just to peak around, say, 4.2, 4.3, so relatively shallow. So if you saw the unemployment rate lifting at a faster rate than that, and inflation looked like it was getting back to target as well, then that would open the door for interest rate cuts.
You've done a terrific job of preempting a question there and answering about government reducing fiscal and infrastructure spend to reduce inflation. So I think we've covered that one. Last question, and we'll finish for the day. If Trump becomes president, where does the smart money go? Question mark.
Oh,
asset prices, liquidity. Last time he was in office, the stock market rallied. Is this likely again? It's the $1 million question. We're all listening.
Yeah, it is. And if the Republicans were able to have control of Congress and the Senate as well, then I think you would see a pretty good rally in the respect that it's quite clear in his campaign rhetoric he wants to extend the tax cuts that he put into place, and he also wants to cut taxes for corporates, and that generally is very positive. It may be that you get a bit of sector rotation from the large cap to the small to the mid cap sectors. And you have to some extent saw that when President Biden, just before he dropped out of the race to become president again, you did see a bit of a sector rotation towards the kind of small and mid cap, because it was thought that future President Trump, if he were to be elected, would put tariffs against, and that would impact the larger US corporations who import and have bigger exposures offshore. So that was very supportive for the small and mid sectors. So I think you could get a bit of sector composition, but overwhelmingly equity markets, businesses love tax cuts. And under a future Trump presidency, if he were to be elected, that's probably a policy that they'll be looking at quite closely as well.
Great, thank you, Tapas, and thanks, Dan. Sort of fantastic information. We've covered a lot of ground today. If any of the information you've heard today leads you to be concerned about the interest rate environment you're facing into, about your floating interest rates, please come through your local market specialist, or I'll be sending out these slides. You can come through me directly or your local banker. As I said, one more time, just a plug for the data that's on the screen, the Morning Call podcast, a great way to capture information. Thank you very much for everyone joining us today and taking the time to dial in.
Thank you.